Good morning. Today is Thursday, November 10th, and we have some very interesting data this morning. We have the CPI report, and other than that, it's a fairly slow news day, so we're going to camp out on that a little bit, talk a little bit about the Federal Reserve's action as a result. Tom, what are the numbers? The estimate was for 7.9% headline, core of 6.5%. Where are we?
To quote a very unpopular president at the time, mission accomplished, everybody. CPI is down month over month. We're seeing improvements really across the board. In CPI month over month, the expectation was an acceleration from 0.4 to 0.6 on the month over month inflation. We actually came in flat at 0.4. Ex food and energy were actually down significantly. So last month's print was 0.6. The expectation was a ex food and energy core acceleration, slight deceleration to 0.5%. We came in at 0.3. The headline number, last month's print, 8.2. Estimated year over year change is 7.9. We came in at 7.7. And then the overall, like the real number, CPI ex food and energy core, the expectation was 6.5. We came in at 6.3. So that's a big number, I think. I mean, if you look at the way the bond market has reacted, we are seeing green all over the bond market on these numbers. I mean, it's not below your socks off drop, but I mean, on the overall number, we're down 0.5% from 8.2 to 7.7, which, you know, in the grand scheme of things is an exceptionally high CPI number, but in the myopic view of we need to get this number down as soon as possible, that's some real positivity, I'd say.
Yeah, I think that's very good news. You're starting to that's surprising and good news. I do think there are some variables that we need to look into. So if we look at the month over month data, we can see the food and energy piece, which was food was still up 0.6%. That was a little bit of a deceleration from 0.8% last month. Energy accelerated primarily due to fuel oil. So your heating oil there was up 19.8% on a month over month basis. But in terms of commodities, you're seeing big declines in apparel, and you saw significant declines in used cars and trucks, which we were talking about before, and that's pretty significant. So if you look at the Manheim Used Vehicle Value Index, you're comping over 224 now versus 205 in September. So it's a much tougher comp, much easier comp in terms of if you come in at 200 this year versus 224, that looks a lot bigger on a year over year basis versus 200 compared to 205. So you're starting to see some of the annualized base effects come through. Elsewhere, we're also seeing a bit of a decline in medical care services, but I'm not sure what that is. I think that's at the insurance expense, health insurance, which the way they calculate the health insurance CPI for this report is a little bit odd. They look at the trailing 12 months and then do that on a month over month basis. And so what we're actually looking at is lagging data on the health insurance side. And I don't expect that health insurance actually will be in the vicinity that they're talking about right now. Right now, it looks like health insurance, medical care services, health insurance was down 4% on a month over month basis, which is, 50% annualized. That's not gonna continue. So I think that this is an unequivocally excellent report. I think that you're starting to see some of the realization of those base effects from the prior year. One area that I don't like to see is the continued inflation in shelter prices. That's continuing to accelerate. Shelter inflation was up 0.8 this month. That's an acceleration from 0.7 the previous month. That's going to continue to levitate overall inflation and result in things coming down a little bit more slowly. Overall, this is good news. I think people are talking. There was a Fed president yesterday talking about on the backside of inflation now. It could be but it could also be a head fake. I am not 100% sold on this, but this is a great report, and we'll see what happens.
Yeah, that's sort of what I was implying with the mission accomplished, roll out the mission accomplished banner, in the sense that this is definitely a small victory. I do worry about if you look kind of down the line here on what's accelerating versus what's not. The things that are accelerating are food, shelter, and energy, which are, I would deem to be essentials. The things that are decelerating are buying a new car, or buying a used car, sorry, new to you, used for somebody else, apparel, and then there was one more that I definitely wanted to hit on. Well, either way, things that are non-essential, I would say. You've got, you don't have to buy a new car, you don't have to buy new apparel, but you do have to buy food and shelter and energy. And so that's
and we all know the health insurance number is phony.
Yeah. And we know for sure that, the SPR releases are about to end. It's about to be winter time. We're going to need heating oil. We're going to need gas. We're going to need diesel. We're going to need all these energy pieces that are suddenly going to be in less supply because the election cycle's over, and the effect of those rollouts was definitely felt. So that was mission accomplished on that end too. But now we're in a period where nobody needs to get elected anytime soon, and so I think that we're probably going to see a reacceleration of energy. And you see that. I mean, the number on acceleration in the fuel oil was 19.8%, which is by far and away the highest print on this October report. So something to keep in mind. But I think, not to be Debbie Downer, this is a great news. We finally have gotten back underneath the 8% handle on inflation, and this is going to be very positive, I imagine, for markets. I mean, I know looking at the bond market, the 10-year has dropped all the way down to 394, which we haven't seen in weeks. I mean, that's a massive move. We're going to see really nice repricing on a lot of the bonds we bought in the last couple of days, and that's fantastic. Let me switch over here to futures.
I mean, there was a CPI report just a few months ago in the summer, where there was nothing that was down. And even just going through right now and skimming, there's a lot of areas that are down. I would say more than 50% of the areas are actually down on the CPI report. You have some big lingering concerns, primarily on the shelter side, although there are some hopes that that's coming down. This is good news. We'll have to evaluate a thesis on where inflation is going. This is definitely a surprise, and I don't want to discount that. Having said that, I don't think the Fed's necessarily going to take its foot off the brake, because if they do, I think that the inflation just continues, and you still have companies like Pepsi and Coca-Cola and Mondelez and next point, the apartment rental company raising rates 10 to 20%. And so I do think that that's going to play through. You have United Health raising healthcare insurance premiums 10%. And so this is all going to play a role, and I think this is going to filter through. But for the moment, it's great news, and it could set us up for a pretty strong rally here today, and then potentially through the next couple months.
Yeah, futures are pretty muted at the moment. We're up across the board about 1/3%, depending on which index you look at least in terms of the live pricing I'm seeing now. In terms of hikes, we're seeing a big drop across the board in terms of the rate at which futures are looking to.
Tom, I see us up 2.9%.
Oh, nice. Let me hit refresh here then.
We're up to
where that makes a big difference. There you go. The Bloomberg, you'll find, does not update very quickly, whereas the internet itself does. So we're looking at the same number of hikes, probably stretched out a little bit more. Right now, we're looking at 2 hikes, potentially for December, 2 for February, and then 1 somewhere between March and June. I would still take the under there. I still think we're overshooting that. I would take that as a sign of caution, that we're already seeing just such a massive move in the number of hikes that we're going to see and when they happen. But, let's take today as a happy day. Markets are up. Bond market is way, way up, especially compared to where it's been the last couple of weeks. I mean, this is just, we're already down to a 390 on the 10-year. I mean, that's big. That's a big move in a short period of time. So everybody go about your day, enjoy it. Make sure to, use this day as a day to look at your account and feel happy, and then don't look at it again for another.
Just look at the change today.
Yeah.
Tom, what a week for Biden then. I mean, this just kind of caps it for him. Great ostensibly very good showing by the Democrats at the midterms, much better than expected, much better CPI report than expected. This has got to be one of the best weeks of his presidency. The Ukrainians taking back Kherson in Ukraine from the Russians. I mean, you had the trifecta this week, and that's good news for him. And it's positive that we're seeing inflation go down. Question is, if inflation starts to decline a bit, and we go back toward 5 or 6%, at what point does the Fed actually start to slow its expectations of rate hikes? How much more of this do we need to see?
I think we need to see the core below 5%. I think we just need to see just steady, continued, maybe 3-4 consecutive CPI reports where we see numbers come down to a reasonable level. I mean, I would say 5% at this point is a reasonable level, half of what we saw earlier this year. And at that point, I think they would probably say, hey, now we're starting to see these rate hikes really affect inflation. They're starting to filter through. It's been, roughly a year at that point from the first signs of hiking or quantitative tightening, and I think at that point they probably start to slow the roll a little bit. Question in the chat from Akash, where was the 10-year yesterday? Right around a 415, kind of in and out during the day. It dropped a little bit overnight.
Terrible auction.
Yeah, Rick Santelli gave it a dismal yesterday on the 10-year auction. So we spiraled a little bit there because nobody wanted that 10-year. Though interestingly enough, I did see a tweet earlier, right before we got on the call, that said there was a massive futures bet that the 10-year would be at a 390 today. They came in like 15 minutes before somebody saw the trade go in, and sure enough, we're at a 393 now. So somebody made a lot of money. Somebody on the inside knew something, because I did see a tweet there, which I thought was interesting. And then sure enough, the economic data played out. So somebody inside the Bureau of Labor Statistics leaked that to somebody with some money. So I mean, that's a big move. I mean, as early as recently as Monday, we were closer to like a 420, 425 on the 10-year, and now we're at a 392. I mean, that's forces of magnitude in terms of, if you're buying that 10-year, 3-4 days worth of gains. I mean, that's a year's worth of bond returns.
Tom, if you're looking to buy a house in the next little while, and mortgage rates go down to, I think they're at 7.2 right now, and they go down to, let's say they go down to 5.75, will you hit that, or would you wait for them to go down lower?
I'd probably hit it. I think that the terminal rate on mortgages is probably somewhere between 4.5 and 5. I just don't think we get back down to the 2.5s we saw last year. I just don't think that's feasible anymore. Particularly if we go the way the Fed says we're going to go, which means they're going to raise rates to 5%, 5.25%, and then they're going to start cutting slowly over time. I mean, it could be years before you get to a 4% handle. So you might as well lock in there and see what you can do there. And it's a big difference. I mean, the delta in terms of your overall spend on a 7% to a 5% is massive over the lifetime of a mortgage. So,
and we talked a little bit about the pivot from the Fed just now. How long does it take for the Fed to actually start slowing its roll on raising interest rates? How much data like this would we need to see before companies start doing it? Because we're in an advertising recession right now. People aren't spending on advertising. This is why we've seen declines at Meta. This is why we've seen declines at Google. Disney yesterday was talking about declines in its advertising business outside areas like restaurants and politics and pharma. How much more data like this do we have to see before companies start turning on the tap skin?
I think months. I think honestly, we're just now getting to the point where companies are feeling good about pulling the trigger on actually making those changes, the austerity measures. So it's almost like the environment gets better as they are also cleaning the balance sheets, right? They're getting rid of of redundancies, people they don't need, CapEx they don't need. They're cleaning everything up. As the situation is getting better, then we get 4 or 5 months down the road, should inflation continue on this path, suddenly they're in a great spot. They're lean, they're mean. The market is clean and lean and mean, and you can kind of hit that both at the same time. We may see a reacceleration out of this, but I think it's going to take, multiple reads like this, 4, 5, 6 months, because it basically took us a year of slowly rising inflation and cracks in the economy to get to the point where now Facebook is like, we're laying off 11,000 people tomorrow. And then I think it's going to take a similar amount of time for everyone to be like, okay, we're kind of out of the woods on this thing. We're seeing continued progress. We can start picking up a few new people. We can start spending money. I think what we see this week is potentially some surprise issuance of bonds. Suddenly we're seeing a great number. We're going to see rates dive here. Are they going to stay low? Probably not, because we know we've got hikes coming. But I think that if you're a good operator, you say, hey, 10 years under 4%, I need to issue some debt for my company. I'm going to fire in right now. I'm going to call up Goldman Sachs and say, hey, let's get some bonds issued right now.
On that note, I think you also have a little bit of a pickup on M&A into the end of the year as people kind of get ready to go. Finally, on the personal investing side, I think it is incredibly important to maintain discipline. One data point doesn't define a trend, but it could start a trend. And so that's why you just have to remain disciplined. I would say that whether it's personal investing or personal finances, bear in mind why we are here, the reason why we are here and even having this discussion. And that is, this inflation was fueled by speculation in crypto, speculation and just buying stuff, baseball cards.
Guilty.
So, and just overspending essentially. And that's why we are here. That's why we're in a higher inflation scenario. So if you find the market going up, you want to participate more and more and more, bear in mind that other people might be thinking like you, fueling more inflation and just getting back to the problems that we have. That's not to say that this doesn't mark the beginning of a trend, but it could be a head fake. It's just something that where discipline is required.
Yeah, I think we're returning to people who are understanding what's valuable, what's not. I mean, there's no reason why a Justin Herbert rookie should be worth $30,000, but you can buy a 1 of 12 Peyton Manning clear card rookie for $100. A lot of people are saying, what's really valuable? Justin Herbert? I don't think so.
All right. On that note, have a great day. It's Green Day, so got to be thankful for that. Stay safe, stay healthy, and we'll see you tomorrow.